Hello and welcome to another episode of the Express Economist. As many of you know, there's mounting tension in Ukraine because Russia has given official recognition to two separatist regions in Ukraine, and that has brought a lot of geopolitical tension in the picture. Today, we will discuss and use this opportunity to understand how such a geopolitical issue typically impacts Indian economy. And so we will ask our guest for today, which is Mr. Madan Sabnavis, who's the chief economist for Bank of Baroda. Exactly two things. One, how such a geopolitical tension impacts Indian economy, and what are the levers through which it impacts us. And we have a bouquet of 4, 5, 6 issues on which we would want to understand from Mr. Sabnavis how the impact will flow. So welcome to the show, Mr. Sabnavis. Thanks for sparing time. I would like to first start very quickly with the impact on stock markets. Now, typically, that is the first port of call everybody wants to know, and that typically grabs eyeballs, what happened to the stock market. So give us an understanding of how this may impact the stock markets in sort of the short and medium term. How would it play out?
No, actually, Udit, whenever we talk of any geopolitical tensions between any two geographies, I think the basic issue is that there's a lot of uncertainty about what will happen next. So until the point of time that we see a kind of an attack by Russia on Ukraine and some kind of action being taken primarily by the United States, I think there will be a lot of volatility in the stock market. So I think this news, which was brewing for quite some time, that Russia would attack Ukraine, itself had created quite a bit of turmoil as far as the stock markets are concerned. And this is not just the Sensex or the Nifty, but we have seen it even globally, where global stock indices tended to move in the downward direction, which is expected from any kind of a crisis situation. Now, how long will this last? To my mind, I think until we know as to what kind of an action in terms of sanctions could be taken by the US or maybe also by the European nations, I think that's until that point of time, I think there will be considerable downward volatility in the stock indices. Now, what we have seen is that the stock market is also fairly agile in the sense that once the news is past it, it tends to recover also. So therefore, we can expect the downward movement to be for a limited period of time. Now, how many days is a bit difficult for one to conjecture right now. It all depends upon what will be the reaction from the Western nations. And as and when they announce it, the market will again take a beating. But after that, I think it will carry on to the next available news.
So typically, when we say market might take a beating or to whatever extent, that is for future news events to tell us. But what I want to understand from a reader's perspective is, does such a crisis, it's not happening on our shores, does this crisis typically lead to a downward movement because foreign investors pull out money? Or could it also be the case that, and I'm just asking a maybe an idiotic question, but does it also mean that there is an opportunity for us to attract more investments or for our stock markets to go up because we are a calmer shore as against the volatility in the Western Hemisphere?
No, I don't think, Udit, at this point of time, there will be investors who will be flocking to markets. See, normally the thing is that whenever there is any kind of a panic situation, people tend to move out from the stock markets, and there's a lot of selling pressure. So typically in a market, there's a buying pressure or a selling pressure. When things are going great guns, and when we heard of the great recovery taking place in the global economy, and that Omicron was not really as serious as one thought, we actually saw that the stock indices were going up and everybody was buying into the markets. But again, not India, in all the emerging markets. We hear about some problem which is happening in the US in terms of the Federal Reserve possibly increasing the interest rates, or they indicating. Now, the interest rates are not increased, but immediately we see that every time the Federal Reserve meets, there is tension in the stock markets. There's a selling pressure which is there. And once the same stance is reiterated, I think this mood continues for a couple of trading sessions, and then it's back to normal. It's mean reverting. So I think that's what we can really be expecting out here. It's seen, actually, it starts off with the American markets, and that is felt the repercussions are felt across all the emerging markets too. And since we follow what happens in the US, so if the US market falls again tonight, that is their trading session, we could be expecting our indices also to move downwards tomorrow.
Right. So I will come to the interest rate question a little later. I wanted to ask about the next big issue that perhaps we face is about the domestic oil prices. Now, we know that possibly because of the state assembly elections right now, oil prices, which, crude oil prices, I was looking at the Brent prices, they were less than 70 in December. And now in the last 2 months, they have now almost come close to $100 per barrel. So that would obviously have an impact on domestic oil prices. So where do you see the impact? Because now the prices are going up further. After elections, where do you see a liter of petrol or a cylinder of LPG being?
No, actually, if you look at the budget, for example, I think they worked on the basis that crude oil price will average between $70 to $75 per barrel. Now, today, as you rightly said, we're moving towards the $100 mark, and it's quite possible that it could go towards $120. That's what I think most of the global analysts are looking at, a number of $120 per barrel. Now, how fast that happens will all depend upon how long this tension escalates and how long it lasts, what kind of action is taken by different nations. So we could be looking at a number of around $120 per barrel.
How much
the immediate impact is...
Yeah.
How
much does 120 calculate for, say, at the current rate of taxation? What would that impact? What would be the price on?
See, we are talking in terms of prices going up by at least another 30 to 40%. I mean, just that is on the basic cost. So if we're talking about the basic cost, which was reckoned earlier in the region of around 80, 85, when we had a price at around 110 rupees for, say, petrol. Now we're talking of that 80 becoming 120. So we're talking of something almost 50% increase, which means that the basic cost of refining in terms of our refineries would obviously go up by another 10 to 20 rupees. Because if you look at the breakup of 110 rupees, I think the actual cost will be in the region of more around 30, 35, not more than 37, 38. Then we have all the taxes which are being added. Now, if you look at the central government, it imposes an excise duty. They had lowered the excise duty by 10 rupees last year. The current budgetary numbers do not really talk in terms of any further reduction. Yeah. So therefore, they have assumed that we are having a normal crude oil market where we're buying at $70, $75 per barrel. And even though when the budget was announced, the crude oil price was in the region of 85, 90. In fact, it will probably also cross the 90 mark. It was assumed that once the new financial year starts, these problems will be taken care of, and we will be back to the situation of around 70, 75 on an average basis. So what we are talking of the price going up by around at least 30 to 40% in terms of the cost of the raw material which goes into making our petrol. So we're actually looking at the cost going up by at least 10 to 12 rupees per liter for something like petrol. Now, the thing is that once the basic cost goes up, I think the onus now will actually fall on the states to decide on what they will do on VAT, because just to distinguish between the two, the central government imposes an excise duty, which is a certain fixed amount per liter. Whereas when you're talking of state governments, it's a VAT, a value-added tax, which goes as ad valorem, which means that it's as a percentage of the cost. So these things keep varying. It could be as low as a single-digit number. It could go up to 25, 30% in certain states. So I think the onus will really fall on the states as to what they're going to do. Now, as you rightly said, that we saw even last year when we have the state elections on, normally nobody likes to upset the apple cart, so therefore the prices have been retained at where they are. But the moment we see the elections, the last votes being cast, so as to say, we could be expecting the prices to be increased. So we could be expecting something in the region of at least 5 to 7 rupees to begin with, and in case that the crisis carries on, and then probably it could be increased further to around 10 to 12 rupees per liter.
Right.
In the absence of any intervention from the governments.
Right. In the absence, yeah, that's the assumption here. And then the next issue is gold. Now, typically, many of our readers would know that gold is basically a flight to safety. Everybody wants, when there's uncertainty, they want to buy gold. Why is that, first of all, and how much do you think gold will? I mean, how would that impact?
So there will be a very big upside to gold price. So for people who are looking to invest in gold, I think it makes a lot of sense at this particular point of time, because we have seen that every time there is a crisis anywhere in the world, there is a flight to safety, as you said. It's considered to be a safe harbor. So people do tend to move away from other investments. So just look at the situation. We're saying the stock markets are falling, interest rates are where they are, the repo rate is where it is. So where do I invest money? So you start looking at something like gold, which is a kind of an assured kind of an asset that you have. And immediately we see that there's a lot of interest in terms of both the retailers. More than the retailers, I think it's the ETFs. The ETFs go big bang in terms of gold, trying to make money out there. And that pushes up the demand for the physical metal, and that will increase the price. So if we're saying what could be the kind of an upside to the price increase, I don't think it could be as substantial as it was during the COVID times, because during the COVID times, we saw the price moving from around $1,200, $1,300 per ounce to $1,800, $1,900. In fact, we felt it could also cross 2,000. Today, we're in the region of around 1,800, 1,900. To my mind, I think around 5 to 7% kind of an increase could be expected in case this crisis remains, say, for a period of at least 2 to 3 months. If it's going to be sorted out in a week's time, then probably there will not be any much kind of a rush to safety,
right,
as far as the investors are concerned.
Right. And next issue is exchange rate, because if oil prices are going up, interest rate movements happen. People pull out money, foreign investors pull out money. That will have an impact on the exchange rate of rupee. And so I want to ask you how the exchange rate might be impacted, and what in turn the impact might be on exporters. Will a cheaper rupee, if at all rupee is going to get cheaper, help exporters in such a scenario?
See, there are two parts to it, Udit. One is when we are talking in terms of what will happen to the rupee would definitely tend to depreciate. One is because my import bill goes up. So the ceteris paribus conditions, we have a trade deficit, we don't have a trade surplus. So automatically the current account deficit will be pressurized, and that itself is going to add to the depreciation of the rupee. The second factor is that in this kind of crisis-like situation where investors keep relooking at their options, reconsidering their options, there will be a case of them pulling out funds from stock markets. So therefore, the FPIs which we are talking of, especially in the equity segments, could be seeing some kind of a sell-off, and they could be moving out of the country. So both the current account as well as the capital account will contribute to a weaker rupee, and that is something which is based on the fundamentals. Now, look at it simultaneously. We have another factor which has actually played a greater role in terms of currency movements. That is what happens to the dollar. As the dollar has been strengthening against the euro, in the past, we remember maybe less than a year back, it was around $1.21 to a euro. Today, it's come down to 1.13. So we have seen that as the dollar keeps strengthening, this extraneous force affects all currencies, and we have seen that most currencies have tended to depreciate. So India also, the rupee also has been depreciating in line. Probably I would say it's been a kind of a global trend, so nothing extraordinary really happening here. So we would be our rupee would be affected by both the extraneous factor as well as the fundamental sterling levels. So therefore, we could be expecting the rupee to depreciate. Now, how much would it go to? We could be looking at a number closer towards, say, $76, 76 rupees for a dollar in the next 3 months, provided, again, I would put this caveat that this thing carries on, this problem carries on. Sure. Now, to the second question of saying, is it good for exporters? Normally, we would say that a weaker rupee is very good for the exporters because you get that export competitive advantage. Now, will this happen in this current scenario? I think we'll have to wait and see. One cannot be very sure about it. The reason being that the kind of tensions we are having out there in Russia, Ukraine, the possible action which would come in the form of sanctions would mean that there will be a lot of disruption to trade. I mean, all the exports, imports which keep flowing from the rest of the world to Russia or away from Russia are going to get affected. And while there will be multitude opportunities for different countries, because if there is any kind of an embargo in terms of sanctions on Russia, it would automatically mean that the commodities which are being exported and imported will no longer be flowing in that easy manner, which means that the markets will open up for the other countries. Now, if impressionistically, I don't see too much of congruence between the kind of goods which we are exporting and a case of, say, that we could be pushing more of our exports into Russia. India-Russia trade is not really very significant. Okay, so we only get indirectly impacted because, like, the crude oil route is there because Russia is the third largest manufacturer, so crude oil gets affected that way. But otherwise, unlike the olden days when we had the USSR, which was there, where there was a lot of rupee trade taking place between the two countries, all that is a thing of the past. So we will have to actually look out. Our exporters will have to see that what kind of changes are taking place in the global economy, which are the goods in which we have this advantage, and whether we'll be in a position to push forward. Because I would put a bit of caution out here, only for the reason that even earlier when there was this issue of can India replace China in the global markets? We do not really see that kind of a bump up to our exports. So therefore, I definitely do see certain advantages for us, but it will have to be in certain specific sectors, and how the commodity prices behave will all be left to see as to how that's something which will be decided by time. I don't think it can be, we can have a clue on it right now.
True. So, and now let's move to the next topic, which is interest rate. We've seen a fairly long period of very low interest rates in India, but there was mounting pressure already from global factors, because the US Fed and everybody have been signaling that the interest rates will be going up there, and so in line, India's interest rates will also be increasing, and already we have a domestic inflation situation, which will be my next question on inflation. But there was always a pressure now that RBI was supposed to increase interest rates at some point. Will this whole event accelerate that whole process?
See, it's a possibility, but we should remember that when the RBI brought out its policy just maybe a week or 2 weeks back, it is very clearly stated that the RBI is going to continue with an accommodative policy. Now, what does an accommodative policy mean? An accommodative policy basically means that they will not be increasing interest rates. Okay, and this is something which they stated would be the policy for the next year, that is for 22-23. But definitely at that point of time, I don't think it was conceived that what we are seeing in the Russia-Ukraine area could actually flare up and reach the kind of situation where we have come today, where it's possible that if the crude oil price really goes towards that 110, 120 mark, then the RBI will have to seriously reconsider what its decision which has taken. Because all the time we are saying that inflation under 6% is something which is tolerable, and the RBI's inflation forecast for next year was 4.5%. So therefore, logically, if you say that growth is still not durable, and inflation is very much under control at 4.5%, there was no reason for the RBI to actually increase interest rates. So I think that's one of the reasons why we saw that the GSEC bonds, the GSEC yields actually came down significantly from the 6.80 plus to less than 6.70. In fact, it ended at around 6.70 last week, but we have seen that the yields have again started moving up today. I'm seeing that 6.76 already, the 10-year bond, which means that there is a market expectation that if this crisis escalates, inflation can no longer be ignored by the RBI, which means that the RBI may have to probably reconsider its call on interest rates. So whether it will be reverse repo or repo will be a matter of conjecture again. But I think the bond yields always signal what are the problems which are there and how it expects interest rates to move. So that is what the clue which we can take from the movement in the bond yields as of today.
So I just want to follow up on the bond yields question. Viewers would like to know, why do bond yields go up and down in such a scenario? I mean, one argument is that if it's flight to safety and people want to buy bonds, government bonds, because it's a safe investment, prices for bonds will go up, and so their yields will come down. Now, why are yields going up right now?
No, see, the yields will move on the basis of sentiment. So today we should remember that when we are talking of the GSEC bonds, it's a case of the secondary market transactions which we're looking at. It's not a case of saying that there are more bonds available in the market. It's a fixed set of bonds which are actually there. And the yields actually move on the basis of two things. One is they always look at what kind of pressure is going to be there in terms of future borrowings of the government. Second, what are the kind of pressures which are coming in the form of inflation moving up? Now, when the government gave an assurance that the fiscal deficit would be at the level of, say, 15 lakh crores, and the RBI chipped in to say that, look, this entire borrowing program is not going to be an issue, we automatically saw that yields started cooling down. Nothing really happened in terms of the purchase and sale of bonds, but the yields came down. Subsequently, we saw in the last couple of weeks, the RBI actually cancelled two of the auctions which were to be held on a Friday. So every Friday we have a central government bond auction which is conducted by the RBI. And when it was indicated that the government's cash position is comfortable and they don't need to borrow, this automatically sent a signal to the market saying that liquidity conditions are very easy. So that's one of the reasons as to why the yields cool down. Now, today when I say that the bond yields are going up, it's more on account of the inflation factor rather than in terms of the liquidity issue. Because today we all know there is surplus liquidity in the system. So liquidity has never really been the factor driving the bond prices or the bond yields. But definitely the prospects of higher government borrowing is something which is something which affects sentiment. And the second thing is inflation. So today it's inflation, which is the overriding factor, which is driving the bond yields upwards. And to my mind, I think that will continue maybe for the next few sessions until we get more clarity about what's happening in that particular region.
So just a very quick question on, do you think that inflation, RBI had a fairly modest expectation of what inflation would be going ahead? Are you thinking that will remain that way at 4.5 or something? Or
No, absolutely. I think it was a very, very optimistic view taken on inflation, because the way we look at inflation is that it will be in the region of 5 to 5.5%. And the only way in which it could even move below that would be more of a statistical phenomenon rather than a real phenomenon. And I say statistical phenomenon because the way we calculate inflation is we look at the index of what it was last year and see what it is this year, divide one by the other. So statistically, in case we have high inflation like what we have had in 21-22, there would be a tendency for the numbers in 22-23 to move slightly downwards. So that is the base effect which we economists talk of. So that is the only reason why we felt it could move temporarily. When I say temporarily, for a couple of months, less than 5%. And that's 5 to 5.5% is the kind of inflation rate we were looking at. Because we should remember one thing, that a large number of producers are in the process of passing on the higher raw material costs, which they have incurred in the last 2 years. And they have not passed it on primarily because of the low demand conditions. Now, as things return to normalcy, we have seen the prices going up. So in fact, all of us use toothpaste, shaving cream. I mean, those prices have started going up. If you look at your biscuit manufacturers, what they have done is they reduced the quantity in the same packet. So their price is kept at 5 rupees or 10 rupees, but instead of getting 50 grams, you get 40 grams, or 75 grams comes down to 60 grams. So there is definitely this process of transmission of the higher input costs into the final prices. So that's why we believe inflation will remain high. And now, in case the crude oil price goes to the levels which we are talking of, definitely there will be additional pressure and they will be accelerating inflation, something which the RBI will not be able to ignore when they meet next time in April. But of course, by April, we'll have a clearer understanding about how exactly this particular crisis is, or whether it has been diffused, whether it's going to be a thing of the past, or whether it's something which is still in the process of escalation.
Right. Last question before I thank you for being on the program. How will this whole event or such a geopolitical event typically impacts the growth of Indian economy? Do you think that there can be a significant impact somewhere, or?
See, I don't think it will affect the growth of the economy in a very, very significant manner. Because if I look at, let's see which are the engines to growth. I say A, consumption. Second is investment. Third is government spending. Fourth is foreign trade. Okay, so these are the four things which we are taught in economics. So the thing is that, will consumption actually slow down? Probably not. Will investment continue to increase? It will increase, but at the same pace of what we expected before, not because of the crisis. Government expenditure, I think it's been driven by FRBM for the states. The center has already made clear that it's going to be fairly aggressive in its capex, so that's going to carry on. Trade, we're not majorly a trade-driven economy, so to the extent that we get some benefits from exports, definitely there will be some benefits for us. So therefore, I don't think the real sector, that is what we're talking of growth, may be affected, but definitely there could be repercussions which come in through currency movements, exchange rates, through interest rates, and inflation. I mean, once we say that the RBI starts increasing interest rates, if the repo rate is increased, that will definitely increase the cost, but that may not militate against growth as such, because we still see that there is surplus capacity in large part of industry. So the need to borrow more for the sake of investment may not be there. So that may not be a limiting factor for corporates. So on the whole, I don't think growth is going to get affected, but definitely on the monetary side, as I mentioned, interest rates, inflation, currency, that is something which could be under pressure.
Thanks a lot for sparing the time and such an insightful discussion. I'm sure our viewers have understood how such a geopolitical tension, and this one in particular, might be impacting the Indian economy. Stay tuned. Next week, we'll come out with another episode of the Express Economist. Thank you.